If you buy bond funds, which most advisors recommend to counterbalance equity risk, they could recommend bonds, but I'm just saying bond funds. You diminish your rate of return quite a bit. You smooth out the ride, but you're left with a pretty anemic rate of return that most people are not very satisfied with, which in my opinion is why Warren Buffett says he wouldn't touch bonds with a 10-foot pole. He says, I wouldn't buy a 10-day bond, even if one existed.
Branden Ducharme is an investment advisor representative of and offers investment advisory services through SCF Investment Advisors Incorporated, an SEC-registered investment advisor, 10150 Meanly Drive, first floor, San Diego, California, 92131, 800-955-2517, www.scfsecurities.com. SCF Investment Advisors Incorporated and Ducharme Wealth Management are separate entities. The information in this podcast is current at the time of recording. It is based upon sources and data believed to be accurate and reliable. The information, opinions, and forward-looking statements expressed herein are subject to change without notice. Moreover, all comments and opinions voiced herein are for informational and entertainment purposes only and are not intended to provide specific advice or recommendations and should not be interpreted as such. Further, the opinions expressed are Branden Ducharme's and his guests and do not reflect the views and opinions of SCF Investment Advisors or any of its affiliates. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what is appropriate for you, consult your financial professional. This information is not intended to be a substitute for specific individualized tax or legal advice. Ducharme Wealth Management and SCF Investment Advisors do not provide legal or tax advice. These services are provided by separate entities. The guest speakers featured in this podcast are not affiliated with SCF Investment Advisors, nor are they affiliated with Ducharme Wealth Management unless otherwise indicated.
So you mentioned that there was a lot of excitement on one of the videos that you posted recently this week, and that there was a lot of comments and stuff going on. What was the meat and potatoes of that video?
Well, one of the things that I focus on a lot, or by the way, are we doing an interview here, or are we just chatting?
We're live. I mean, not live, but yeah, we're going.
He can copy this. Okay. So I think my mantra is that the way I look at things is I'm mostly focused on how to reduce risk.
Okay.
And when you're in an up market, a long-term bull market, talking about downside risk is not the most popular topic.
Mm-hmm.
They don't really want to talk about it. Anybody can invest. You can do anything. You throw a dart and you do pretty well. You just throw it in the right sector and, you do well. And it's, AI or tech or whatever. And so when you start talking about managing risk, managing deep downside risk or intermediate term downside risk, it kind of falls a little bit on deaf ears. People really, they have amnesia about the periods of time where it's been horrible. And so, but that's what I focus on. I focus on protecting downside risk, because there will come a time that if you haven't addressed that properly and you haven't adequately protected downside risk as much as you can, it won't go well for you and for your client. So, but that's what I focus on. So my YouTubes are really mostly focused around, you can see it on my website as well, mostly focused on managing downside risk and what's coming. Now, this week, I did a video. I share videos of other people, and I shared one of David Hunter, who is he's been around for 50 years. He's well known. He's not like Warren Buffett, but he's well known in the investment circles, and he's a macro economist or analyzes macro cycles. And I also showed one of Jeremy Grantham, who does the same thing. This is my third time of showing Jeremy Grantham. And with David Hunter, he talked about we're at the last phase of the last part of the cycle of 40 years, from 1982 till now, a secular cycle. And I didn't think of it that way, but he considered 2000, 2008, 2022, 2020. He considered all of those cyclical cycles inside of this longer 42-year secular cycle. And he said, we're at the end of it. And next year, 2025, will be the decline when we go out of this bubble or secular cycle, and we go into a fairly deep decline that will become a bear market, maybe a secular bear market. And then it ends in 2030 where everything collapses. Whether you agree with that or not, I played that because I wanted people to understand that we do go in cycles. The market goes in cycles. And we have been so numb to the fact that there are cycles and that this is just an up cycle that, I have a lot of people who agreed with me on the video, but there are some that don't. And so but that's okay. I'm just trying to make people aware, whether you think it's 2025 or 2026 or whenever you think it's going to be, there will be a drop that will be significant, and it will be very different than the way it is today. So that's my message. So when people resonate with that, they think that way, then they usually just give me a call and we have a conversation and, see where it goes.
Yeah. Well, or guys like me will allocate to your strategy too, obviously.
Right. It's got a lot of defense. A lot of defense.
Yeah.
In it. So there are people who I could put more offense in our strategy, but I choose to try to get a balance because I know there will come a day where I don't want to lose sleep. I don't want you to lose sleep. I don't want your clients to lose sleep. Is like,
Well, I think one of the things that's unique about the way that guys like you or I manage money is almost more sometimes like the commodity space, right? Where you can look for small moves in the market and then apply leverage as needed. But the important thing is to have your systems built and your investment thesis built around a optimal pain to gain ratio, right? However you decide to define that, whether it's based on tail end risk or, limited drawdown or, standard deviation, using a standard deviation as measure of volatility, whatever it is, as any individual investor, but if you find a pain to gain ratio that is favorable, well, then you can just say, well, if I want more return, but I like the ratio of pain to gain, I can just use leverage to more or less, right, increase how much return, but pain I would potentially be bringing on. And so if you look to manage risk and say, well, managing risk is going to be my way to getting the right pain to gain ratio. And then if I need more return and I'm willing to take more risk, but in the same ratio, well, then you can use, a tool like leverage. Mm-hmm. Have you ever talked to Jim Lee about cycles? Do you know Jim?
I do know Jim, and I have not talked to him about cycles. I watched his interview that he did with you, and what I was so fascinated, and of course I respect Jim, and what I was fascinated about in his interview was the fact that he uses AI. And we started implementing AI in our models on May 1. And it has produced, in a very short period of time, has done very well. I'll just say it that way.
Sure.
Beyond the benchmark and beyond what I expected. And, but that's such a short period of time, in one particular market. But I'll look forward to a conversation in October with Jim to learn more about what he's doing with AI, and I'll share with him what we're doing. And but no, I respect him.
Yeah, he does a lot on cycle analysis, and really he turned me on to looking at cycles a little bit more like that, which I know is not your thing, right? You're a lot more on the momentum side. of the
Right,
market.
right.
But
Well, we're looking at ways to
yeah,
take advantage of momentum on the upside and the downside,
yeah,
but I don't analyze it from a cycle perspective. But the
right.
video I just did with David Hunter and
It
Jeremy Grantham, they do.
it's still good to be aware of the cycles and stuff,
Right.
though. And Jim had some really interesting thoughts about different cycles coming together. And what's interesting is when you do a cycle analysis, right, you have to phase in your different harmonics, and then you have the amplitude, right, as they bottom together. And so as cycles come together, you can have big effects, but you can also have a point where cycles should bottom up because another cycle is peaking. It kind of can offset that, right? So a sub-cycle or a different harmonic can offset. There's a lot to cycle analysis, right? I've learned painfully so in the CMT program. There's a lot to cycle analysis, one of my weaker areas. But there's interesting stuff. So when you talk about momentum though, right? So, I use in a lot of portfolios I manage for clients, one of your strategies, and it's a momentum strategy. One of the things that's unique about it is it not only is invested in momentum in the market, so it can go to cash or go long. But when it goes long, it can have a tilt or a favorability factor to either a growth proxy or a value proxy, depending on kind of where the momentum in the market is. So it definitely has a long bias to it. In my observation, how did you come across the idea of managing with a momentum factor?
This came about, Branden. Good question. This came about with some analysis we did several years ago, where we could see we did a relative strength analysis on value and growth. And if you, through your charting and your analysis, you have the ability to contrast, doing a relative strength basis of value and growth, you can see there are clearly times where you want to be in growth. There are clearly times you want to be in value. And then there's, some times where it kind of goes back and forth. You have to put up with that. And so over time, we compared the, hypothetical simulated results of different scenarios. And we found that by emphasizing growth or emphasizing value, we would pick up we would reduce risk, and we would pick up some increase in rate of return. So one way to do that is you could do QQQ divided by DIA or vice versa, or you could take SPY G divided by SPY V, and you would see these periods of time that are they go it just flat out increases your rate of return if you can find a way to favor one versus the other. Well, so we do that.
I think just a quick important clarification point for anyone listening: you're not recommending those ETFs. That's just the inputs for a calculation to see how they outperform.
Yeah,
right?
Exactly. It was just part of our analysis and
calculation.
It's we do it as far as how we manage money, but no, I'm not making a recommendation. I just want to give you a specific.
Yeah. No, that's a great example. So, so that gives you the relative strength on the factor side of it, right? Whether you're in growth or value. In your own personal experience, what drove you to want to even have a tactical strategy where you were both changing factors, but potentially being out of the market, right?
I'll try to keep this brief. Back in, and I sold my company. I was in another industry many years ago, and I sold my company and I retired. But when I retired, I had money to invest from selling the company, and I didn't know really anything more than the average person, probably your average client. I didn't know more than they did about investing. I knew something, but not much. And so I was in Seattle at the time. I went to four um, advisors. I'll call them, they were all traditional, but I didn't know the difference. So I went to them and said, what do you recommend I do? And they all recommended about the same thing. They all thought they were different, but in reality, they weren't that different. And I I looked at all of them. Now I was a business guy, so I was involved in. Started and grew three different companies, and I I was used to taking business risk and managing companies, but I was not oriented to the stock market as much. So I went to them and said, "What do you recommend?" And so they said, "I recommend this." So as a business guy, I'm looking at that and saying myself, "What does this look like?" And to me, it looked like too much risk. I would not make enough return to offset the risk. That's just my opinion as a business guy. And I'm looking basically at the stock market. And they, uh, I told them, I said, look, I just think that's too risky for me. So I'm going to step aside. I'm not going to do anything. I'm just leave my money in money market. And they didn't like that answer, but that was that turned out to be October of 2007. Let that sink in. So I left my money in money market and I watched from that moment, actually, the market collapse over 50%. And I realized, A, I'm not smart about this. This is just a gut feel, but that they were uh, bought into a paradigm, a way of managing money by just putting it on in the stock market. And if I put it in at the top of the market, which by the way they were recommending, well, that's the way it goes. Well, it took, if you do check the numbers from October of 2007, which is when it was, to April of 2013, 5.5 years later, before I would break even with where I started. That's terrible.
Yeah.
So they did not understand cycles. They did not understand, really, in my opinion, didn't understand managing money. All they understood was asset allocation, throw your money into the market, and it is what it is. And and I realized my opinion is I thought that is kind of the traditional, and all of them believe that. That's the traditional method. So that propelled me after I took a couple of years off to play golf and do some reading and so forth. I I came back to it and did my own analysis, and it took me 5 years to figure out for myself how to manage my own money in a way that I could minimize that risk and participate in the upside. It just I didn't know anything about the business, so it took me a while to learn the business. And then that through conversations with friends of mine and so forth, it ended up propelling me into the industry of managing money. And so now I manage money for myself and quite a few clients. And, but it all began with this journey of trying to figure out how to manage risk. But the traditional method is, as you know, Branden, the traditional method is you buy stocks and bonds. Stocks by themselves, or for that matter, bonds by themselves, are too risky for most investors. Now, if you want to just buy bonds, that's okay. It's a very low rate of return, and bonds are bonds. But if you buy bond funds, which most advisors recommend to counterbalance equity risk, they could recommend bonds, but I'm just saying bond funds. Then you diminish your rate of return quite a bit, and you smooth out the ride, but you're left with a pretty anemic rate of return that most people are not very satisfied with, which in my opinion is why Warren Buffett says, you know, he wouldn't touch bonds with a 10-foot pole. He says, I wouldn't buy a 10-day bond, even if one existed. Well, that tells you a lot. He's the best known investor in the world, and he doesn't want anything to do with bonds. So I just, and if someone, you or someone invests in bonds, I hope I don't offend you, but I don't use that method. So I figured the best way for me after analysis was to find a way to minimize the downside risk of equities and participate in the upside. And that's what I do. So I don't, I accept whatever risk goes with that, but I can live with short-term volatility, but I don't want to accept deeper risk than that.
Yeah, I have a couple thoughts. One is when you talk about the low rate of return potential in bonds. The bond world is very interesting as a whole, and there's a big universe for bonds. So trading leverage exposure on long dated treasuries where you're picking up duration risk, using the duration risk volatility as a form of leverage, and then leveraging that and trading that, long short based upon macro views is wildly different than owning senior bank loans that are floating rate, which is also wildly different than owning short-term treasuries, which is different than owning, high yield bonds, or just different. There's all kinds of stuff in the bond space, but I think you have hit it on the head that if you if your idea about bonds is to own a bond fund, I think you're missing some really easy pick me up money from just doing some additional critical thinking about your bond allocations. But if you are okay with that low rate of return, what you do pick up is actually you shed the volatility risk, you pick up inflation risk, and it can be significant. And people have learned the last couple of years that bonds carry more risk than maybe they initially thought. Advisors have learned that, and the equity markets, for what it's worth, sometimes have bailed them out, so to speak, on that a little bit, where they haven't had to have the same critical conversations. But bonds have been in a bear market in a pretty big way and continue to be, and I think will be the both the macro environment and the charts indicate it would probably be this way for quite a while, potentially, years and years. That being said, the idea of being invested and being okay with shorter term volatility, right? How did you come up with the idea that you're okay with shorter term volatility? You're okay with, mild drawdowns, frequently, which is going to happen in equities no matter how you invest, right? Any given month, 2 to 5% down is so realistic in equities. But to avoid what you're saying is, major market corrections or crashes, how do you square up yourself with the idea of being okay with volatility on the top end, but just trying to avoid the big drawdowns?
Well, right now we're using AI. Prior to this, we used an internal market indicator. We don't use price. Some people use price. I think it's a horrible. In our simulation model, we have found that using price as a method to calibrate movements in the market is, in my opinion, very disappointing. So we used an internal market indicator, but now we use AI, and AI is able to see things that we don't see. And so, but I think, what we're looking for is a ratio of rate of return versus risk. And we want that ratio to be very favorable. So to do that, in my opinion, you have to focus heavily on risk. We've got over a long, long period of time, certainly 40 years and probably longer, we have an upward bias to the market. Mm-hmm. So you have to be, we have not experienced for a long time, we've not experienced a down market. I think we will experience one. And when we do, it's going to be very hard for a lot of people. But until then, we're just trying to manage inside of what we know right now. Where we are is we are riding the wave. We're invested. We've been invested for quite a while, and we're enjoying that. But we also have one foot that is ready to hit the brakes when this thing changes. And we have a method to determine via AI. We have a method to determine when that is. And we're, I try to keep my own opinions out of it and just, we're going to go with whatever the market says.
Yeah. Well, that's an interesting aspect too, is that what you guys do is fully rules based, right? It's quantitatively driven.
Very quantitative.
And it's not subjective to your personal views or opinions. The data, data's the data, the signal's a signal. And if all the data says be out of the market, you guys are out, right? It's, right. Your methodology of managing would be, you'd be in cash. And the way that you've described that to me in the past is, you're invested in periods when it's favorable, and you're not invested in periods when it's not favorable to do so. And that's the idea of a momentum strategy. But also, they're nimble enough. If you're in a big fund, it's too cumbersome to try to tactically get in and out of the market like that in a large fund. So you have to appreciate the small scale of what you do and the feasibility that it creats around the
And that's where you take a guy like Warren Buffett. I mean, he can't go in and out of the market. He can't. Warren Buffett is a market timer. Bottom line, he's accumulated $189 billion of cash to look for the right time to deploy that. That's market timing. Mm-hmm. But he can't move out of positions that he currently owns because he owns so many shares.
Yeah.
So, but he's tactically managing the market with his particular value-oriented method.
Yeah, I think people forget that Buffett's actually a very active manager.
Very active. He looks at it every day just as much as we do. He's more on the buy side. We're willing to look at the buy and the sell side. But, otherwise, if you just take your money, again, I hope I don't offend people, but if you just take your money and you put it in the market and you buy stocks and bond funds, or equities and bond funds, and you leave it alone and you don't try to manage that in any way, there will come a time, we haven't seen it for a while, but there will come a time where that will become very, very disappointing and frustrating. And again, I come back to the interview I did this week on my YouTube, where I talked about, played the interview that David Hunter did with Jay Martin, and he talked about we're at the end of this cycle. And if you look at these, I wish I could show you this chart, this macro cycle of bond yields. It's a cycle of bond yields and bond prices. It goes back to 1945 or so. And there were 3 or 4 cycles in there. And you could see these. I'm just going to do it with my hands. It's like this. When bond yields go down, bond prices go up. Mm-hmm. And vice versa. And then they turn and they go the other way. These are long-term 20, 30, 40-year cycles. And in those periods of time, there's movements of up and down, but generally they are going from one corner of the screen to the other. And once you understand that, that's a micro view. I don't manage money that way, but it gives an illustration of how these periods of time, you want to be out of certain things and in certain things. Effective money managers, those who manage billions and tens of billions, etc. They don't do what your average financial advisor does. They don't just put your money in the market and let it ride. They manage it. You look at I don't know how they manage money, but I mean the Ray Dalios and Jeremy Grantham's and certainly even Warren Buffett's. I mean, they're making buying and selling decisions to say we want higher exposure here, we want less exposure here. You've got to do a lot of analysis. But a financial advisor who just puts your money in the market and charges you 1% or whatever they charge, I think they're charging way too much money for way too little work.
Yeah, well, they charge a management fee, but they're clearly typically not managing anything.
They're not managing. They're just putting your money there and not even watching it. They're just letting it sit there. There's nothing wrong with charging a fee. I charge a fee. Sure. But what are you doing for that? Are you really? How are you managing my risk? How are you managing my return? There's some combination of those two, and each person has got to. If you try to address that question, there are ways to do that are quite varied. I use one method. Other people use different methods, but if you don't do that, there's going to come a time where it's going to become very disappointing. I went live with my YouTube I started doing them in 2022, and that was generally most of the year was a down market, and I didn't know that at the time. I just started doing them in January or February, and I was getting calls from all over the country. I mean, I think I literally got about 100 phone calls from people who were watching my YouTube videos and saying, well, I agree with you. My financial advisor is doing nothing. Nothing. I don't care what they do. I don't care if it's the right thing to do. I just want them to do something. That's the message I was hearing. And so when I talked about just making decisions of getting out of the market and so forth, they go, wow, you're the only one I've ever talked to that said that. And it was really eye-opening for me to realize that so many people, so many advisors don't do it that way. And again, if I offend someone, I apologize. I'm not trying to do that. I just am giving you a flavor of what I see out there in the marketplace with the average investor.
Well, if you think about the average advisor, it's not a bad business model, right? Use the index funds, use the tailwinds of the market. If the risk isn't managed, there's an easy cop out, which is you're just not thinking long term enough, right? It doesn't matter that it's 08. Hey, by 2013 or 2014, you'll have your money back. You're just you're not your time horizon isn't long enough,
right?
And to a certain degree, Ben, advisors that do that and they coach their clients through holding through the down markets, and they can effectively have that hand holding. There is some value there, but it is, you and I both have talked with clients and people that it is so emotionally difficult, no matter what an advisor is saying, no matter what charts you show somebody, no matter what history says, no matter what anything, if you're that person that's in your mid 60s and you're about to retire, or you just retired and you're seeing a market drop and you're seeing years and years worth of income for you be eviscerated on each monthly statement you're getting, it is very, I would say, near impossible for most people to just say, oh, well, I'll just write it out. No problem. It'll come back. It is not that emotionally easy. And so then what ends up happening, in my belief, is that they just sell out anyways with or without an advisor. And if you do the studies on active management, timing when to get out of the market is actually not super difficult. It's having the rules in place on when do you get back in.
Right.
That is the challenging part. And that is the part that no one's perfect at. But by far and large, when you see people get out on their own, they tend to never get back in. And that is a disaster.
Well, Branden, I have a client that was very much like that. when he became a client, he said, I got out when it was dropping in 2008. He called his advisor and said, get me out of the market. I can't take the pain anymore. And the guy says, I'm not going to do it. So he said, okay, well, I'll do it. And he went out of the market. This was in 2020. From 2008 to 2020, he never got back in.
Yeah. And that was a great bull market to participate in. In fact,
he wanted to, he just couldn't pull the trigger.
That bull market was so significant that you probably have more risk in not participating.
Well, yeah, of course.
You know, it's
see what happened. If I could show you a chart of TLT, the long-term government bond ETF.
Yep.
If I could show you a chart of that for the last 5 years, you would see from one corner of the screen to the other that it dropped about 50%. Now, that's the long-term government bond. Not everybody's in long-term government bonds. You have corporate bonds and you have intermediate-term bonds and so forth. But most bonds are correlated, at least. And so bonds over the last 5 years or so have dropped a lot.
Mm-hmm.
So what was intended to be a tool to manage equity risk has become a higher risk than equities in many cases.
Yeah. Oh, yeah.
And so those who are in the 60-40 portfolio, and of course, I don't have clients that do that, but if they did, I can imagine they and their advisors are having very difficult conversations about what is this thing about 60-40 and 50-50 and all this. It's not working. I'm getting crazy low returns and I'm taking huge risk. In 2022, many bonds, not all, but many bonds went down more than equities.
Yeah.
Crazy. And they both went down.
Well, I think a lot of people don't understand.
But we're in a different environment. We're in a different regime. When you look at these long-term cycles of bond yields and bond prices, you can see that there's a time to be in bonds and a time not to be. We're now in a period, for the last several years, we've been in a period of increasing bond yields and decreasing bond prices. Now, if you own a bond is a bond.
Mm-hmm.
But if you own a bond fund or a bond ETF, which I think many advisors put their clients in, from what I've seen, you're not counterbalancing the risk. So you scratch your head and think, well, how do I mitigate the risk of equities? Very good question. My answer is tactical management. Each advisor has got to figure out for themselves what works for them. But that's my answer.
Yeah. Well, I think going back to this bond conversation, which I'm pretty intrigued in, I really actually enjoy bond conversation, bond analysis, and you having the opportunity to use bonds as ballast in a portfolio. And I think there's still merit to that. It's just so wildly different than it was, right? It was for a while since ZIRP policy or zero interest rate policy started, it was, you have bonds as ballast, and, when times get tough, they're going to lower the interest rate from, 2 to 0. And when that happens, there'll be a flight to, what people didn't really realize was that correlation came from a flight to quality. And so people would buy the US Treasuries, pushing the yield down. When the yield goes down, the price goes up, right? So you kind of had this negative correlation for a time to stocks, and it became your crash protection. But in order to have that crash, quote unquote crash protection or ballast in the portfolio, you had to pick up a decent amount of treasury duration risk. And so you were a bit further out on the yield curve. That
interest rate risk in general.
There's a bunch of interest rate risk there. Now, that theory, I think, is still the way it is taught in academia. I mean, I graduated school, and that's how they taught us in the finance program at the tech school I went to. Bonds are your offset. They're your ballast. That's your safe position. Well, if you have, non-rated equity position in a CLO, that is a way different bond position than having 3-month T-bills, right? Or if you have even a high yield bond that is, maybe it's a triple C or a double B, and it, but it matures in 12 months time, right? Like you said, if you own a bond, you own the bond. Bond funds though can be different, but there's still a lot of opportunity in bonds. And I think where advisors actually a lot of them miss is being more strategic in their bond allocations to have the correct bond allocations to complement what they're doing in the equity sleeve. Or there's that opportunity. I know you're not a fan of it, and that's okay. But I think especially if you're going to be just an index guy, right? If you're going to quote unquote put the money in the market, you really have some opportunity to look at different bonds and do some interesting things that make sense, that produce some yield and is risk managed. But bonds are still a risk asset. At the end of the day, bonds are still a risk asset. So the other thing that I keep thinking about as we talk about these bond positions is inflation and the inflationary cycle that we're in. Have you ever heard about kind of the, how do I want to phrase this? You're familiar with the hyperinflation in Germany in the 30s, yes, right?
20s.
Say that again?
In the 20s.
20s, yeah, 20s.
1919 to 2023.
Yep. Just after World War I.
Yep.
And what's an interesting study that people can go back and look at is that older Germans got wiped out by that really bad. Mm-hmm. And it was because they had bought bonds, and it was supposed to be the safe position, right? Well, if you're in an inflationary environment, you're getting paid back in inflated dollars. So, you borrow somebody $1,000 and, it's supposed to pay 5% for 5 or 10 years. And, a couple months later, people are buying a cup of coffee for $1,000. They just pay you back. You got, you had no chance to outpace the inflation. Younger Germans bought a lot of stocks, and they bought a lot of equities and hard assets, and they fared really well. And there was actually a huge wealth transfer that occurred, from my understanding, between older Germans and younger Germans in that time period because of the two different mindsets. One was, I'm looking for the safe play. And the other one was saying that appears safe on its face because it protects principal, but it's not protecting purchasing power. It's not,
right.
It's a different risk profile. It's not risk-free. Right. It's a different risk profile. And in the current environment, that's not the risk profile I want. So they bought equities and it fared well for them. So I think that gives a lot of merit to what you're trying to do with being the equity markets. Just do it and do your best to have a rules-based quantitative system that helps you be exposed to the equity markets in times when the market is producing favorable conditions.
Good.
Did I sum it up right?
Yeah, that's very good, Branden.
We've been friends for a while, I think, Ben.
It's helpful to look at things like the Weimar Republic and other economies that have gone through hyperinflation. I bring back to this, and if your audience is interested, I would suggest that you put in your YouTube search engine David Hunter and look at his recent interviews, particularly the one with he did with Jay Martin, and he's a very smart guy, and he's 50 years of an excellent track record. And I use that as a point of reference because he is saying that when we go through this next down cycle, which he thinks is maybe a year or so away, because he's macro, I'm going to say it could be 6 months to 2 years away. He says that we are probably headed, because the Fed, he believes, will do everything they have to do. They will throw everything in the book at this to keep it from collapsing, which makes sense given what we've seen of the Fed. And as such, he thinks that interest rates will go to 15 to 20%, inflation will go to 25%, and that this is not the big collapse. This is just the next year or two. The big collapse is about 5 years later. But in that scenario, he's saying that, we're going to deal, that's not hyperinflation. It's a very high inflation, but it's not hyperinflation. And so, but we have never dealt with a scenario like that. And then he talks about unemployment at 50%. I don't know if that's in the 2025 range or closer to the 2030 range. But when you come as a money manager, when you come down to this thing, how do you manage risk? And if that happens, let me tell you this, what's going to happen is bond yields are going crazy high. And that means that bond prices are going crazy low. And 60-40 portfolios, the equities are going down and the bond ETFs are going down big time.
Yeah.
And so people who buy into that, that's why I don't buy into that philosophy, because I believe that whether it's next year or whenever it is, that is going to happen. And if the Fed is throwing everything they can at it, they have nothing left, then, as he suggests, that the next trick is a few years later, and that's when everything collapses. And I don't want that. That's not a pretty scenario. It's not, you don't want it and I don't want it. But if it happens, I don't want to lose my client's money. I don't want to lose my money. And that's why I believe in tactical, because buy and hold, 60-40, whatever you want to call it, in my opinion, will fail like it has never failed before in that scenario.
Only time will tell.
If I didn't previously offend everybody, I think I did by now.
I think you've done a sufficient job with that last statement, but there's value to it, to what you're saying. I think, and there's some merit. And I am probably a little bit more of an optimist than you are. And maybe it's because I'm just a little bit more youthful in years by just a couple, and haven't seen as much, but so I'm not a doomsdayer guy myself. I personally don't think the market's going to have a great depression on steroids type collapse. I don't think, there's going to be a 50% unemployment. I really don't subscribe to that philosophy. I'm generally really optimistic about the future. I think there's a lot of positive things. But I also think that if you have, a 50% drop in equity prices without a change in monetary supply, or you have no change in stock prices, but a doubling of the money supply, it's both the same thing, right? So
in a way,
I think in a way there's a decent chance that over the years we'll see a recession of sorts in terms of real return in the markets, and you might have a real loss in the market, but a nominal gain once you inflation adjusts everything. That could happen. That certainly could play out, I think. And so being exposed to the right stuff at the right time can help manage that. Not to say anyone's perfect or that, you'll nail it, but you got to try, right? And then the other thing is I do think that there is always the looming risk, right? That you could have a relatively quick 30 to 40% drop in the equity markets. I think that's generally on the table almost at any time. Now there's periods where it's pretty favorable and things look pretty good, but I think one of the things that is like very concerning right now, for example, is there is more short interest in volatility. There's more short vol out there than there has ever been before by a significant magnitude. And in significantly more than what there was that caused Volmageddon in 2018. And luckily that did get under control relatively quick, but that was a pretty big spike in volatility, and there was some drawdowns, and 2018 ended up not being a super good year for investors. Happened to line up with the presidential cycle too, which is interesting to think about. But so if that short vol trade unwinds and volatility spikes and stuff comes down, there is a real chance that stuff could come down 30%. Now, my whole belief around all this is that if you are in retirement or near retirement, you don't want to see a 30% drawdown because
Right.
there's a decent chance it comes back relatively quick. But what if it doesn't? You know, if you're the guy that was making $50,000-$60,000 a year over your career and you got $1 million saved and now you just watch $300,000 eviscerate in 1 or 2 months, that's like 6 years of your working life. You know, and years and years and years of retirement income. And then the disastrous effect it has that if you need to take distributions to live on during that time when you're in that big drawdown, it's very, very, very expensive. And so limiting those big drawdowns can have a significant impact on the chances of success or probability of success of your financial plan and just making it across the finish line to the end with, you know, assets intact. So we have a little bit of different views. Again, I'm just maybe a little bit more of an optimist than you are, but I think we're both trying to protect against the same thing. And I want to sleep good at night. Clients want to sleep good at night.
Right.
And no one likes looking at their statement and seeing that they lost 30-40% and it's not coming back, you know? So COVID was an anomaly. That recovery was quick and violently quick, but that is atypical. So anyways, I appreciate what you do, Ben. You've done a lot of work with not just you, but with your son, Spencer, as
Right.
well. A lot of research you guys have done and a lot of systems development to build a rules-based quantitative system like you have. And it's done a nice job doing its job. It does what it's supposed to.
Brad, thank you, Branden. I've given you kind of a negative view, and I don't mean to do that too much because I try to balance my view. It's somewhat positive and somewhat negative. And we don't manage money based on my view or Spencer's view. We do it based on our mathematical model, and now it includes AI. So whatever it says to do is what we do. If it says to be invested, which it has for quite a while now, we just stay invested. When it tells us not to, we're not going to. And so I don't, I may play a guy like David Hunter or Jeremy Grantham or Felix Zulauf and so forth. I may play those, but I don't manage money based on what they say.
Well,
so
you almost can't, because if they're wrong, you could lose so much money just by waiting for them to be right.
Right. And you take another guy you take is Mike Wilson, the chief investment officer of Morgan Stanley, U.S. equity strategist. He's a very smart guy. I respect him a tremendous amount. And he is voted by his peers on Wall Street as the number one money manager on Wall Street, like many years in a row. And yet he called it so wrong in 2023. He couldn't have been more wrong. And he was bearish the whole year. And 2023 was a fantastic year. And he's looking at all the earnings reports, and, these analysts are calling the CFOs and saying, what do you expect earnings to be? They're plugging it into the computer, and the model didn't work. So of how much respect I've got for Mike Wilson, I don't manage money based on what Mike Wilson says. I guess Morgan Stanley does, but I don't. And that's why, for me, following a mathematical approach is so much better, because it takes me out of the equation. Because if you left me in the equation, I'll get it right sometimes and I'll get it wrong sometimes. And I think as part of the name organization that you and I are a part of, there are so many managers who are, and I don't know every one of them individually, but my perception is that all or most of them manage money in some kind of a objective manner that is not emotional, and they make changes in portfolios based on some kind of a mathematical model, and that's why I respect the organization so much, and like you, so many of the people there that I enjoy getting to know.
Yeah, it is always a good time. So, anyways, well, I appreciate you hopping on today, Ben, and sharing some of your wisdom with us. You certainly have had a unique journey coming through the success in your prior careers, being a business owner, having your own skin in the game, I think, is a really unique. There's so many managers that they're not invested in their own funds, even on Wall Street.
Yeah.
And so, this is a journey that you right. started to just manage your own money, and you developed systems, you learned, you taught yourself. And, then you developed appropriate systems. You did all the right things, and now you're able to share that with other people. And we appreciate that. We've been working together since 2021, or was it 2022? 2022. It's a couple of years now, and I'm very appreciative of the relationship that I have with you and Spencer.
Thank you very much, Branden. I enjoy it as well, and I'll speak on behalf of Spencer. I know he feels the same way.
Yeah, sharp. He's a sharp guy. So, anyways, well, if people want to check out your YouTube channel, Ben, remind me, it's just Reppond Investments.
Just put Reppond Investments, REPPOND Investments in the YouTube search engine, and you'll find it.
Yeah, and
I come out with 2 every week. One is on the market, one's on the economy, and see what you think.
Yeah,
thanks.
And if anyone has any questions, reach out to Ben or reach out to myself. We have access to his systems and implement them as appropriate. And so I can field some of those questions, or, reach out to Ben directly. It's whatever scratches the itch. So
thanks, Branden.